Welcome to The Explainer. Today, we're diving into a pretty critical warning from one of Wall Street's top analysts over at Bank of America. They're pointing to a single, incredibly popular trade that they believe could be a hidden trigger, one that could unravel the entire market. So let's break it down.
Okay, let's get right to the heart of it. Here's the quote that's got everyone talking. The big concern is a disorderly unwind of bets against the US dollar could spark a bigger risk-off. Now, that's just Wall Street talk for investors suddenly getting scared, dumping risky things like stocks, and running for cover. And it all comes down to this one huge, crowded bet against the dollar.
So what is this short dollar trade that has Bank of America so concerned? And, the big question is, why should you care? Why could its reversal be such a big deal for your portfolio? Let's get into it.
To put it really simply, this is just a massive consensus bet that the dollar is going down. A ton of investors are borrowing dollars, which have been pretty cheap to borrow, to go out and buy other riskier assets. They're hoping to win twice, once from the asset going up, and again when they pay back their loan with dollars that are worth less.
And this is where it really hits home. Just look at this list. We're talking about everything from the big tech stocks in the NASDAQ to gold and even crypto. A huge range of the most popular investments out there have been getting a boost from this one simple idea. They've all been riding the wave of a weakening dollar.
But here's the twist. While the crowd, the general consensus is betting big against the dollar, the technical charts are telling a very, very different story. In fact, they're flashing a major warning that the exact opposite might be about to happen.
This is where we get a little technical, but stick with me. The report points to a classic chart pattern called an inverse head and shoulders. Now, you don't need to be a charting wizard to get the takeaway here. It's a pattern that often signals a big reversal, from a downtrend to an uptrend. So what does that mean? It suggests that while everyone's been selling the dollar, some big players may have been quietly buying, building up pressure for a major breakout to the upside.
So what's the tripwire? According to Bank of America's note, it all boils down to this one number, 102. That's the key level for the dollar index, also known as the DXY. If the dollar can break and, more importantly, hold above this level, well, that could be the signal that starts this whole unwind.
So, what happens if the dollar does rally past that key level? Well, everyone who bet against it is suddenly in a really tough spot. They're going to be forced to rush out and buy dollars to close their losing bets. And all of that frantic buying just pushes the dollar even higher, creating this vicious feedback loop. You've probably heard it called a short squeeze.
But the warning signs aren't just in the dollar chart. If we peel back the onion a little and look just beneath the surface of the big stock market indexes, we can see some other signs of weakness that suggest this rally might be standing on shaky ground.
Let's talk about something called market breadth. Think of it like this. Imagine an army is advancing. Is the entire army marching forward together? Or is it just a few generals way out at the front, while most of the soldiers are actually falling behind? Strong breath means the whole army is moving together. Weak breath is a problem.
And this slide shows that problem perfectly. Analysts have a great name for it, an alligator jaw divergence. On one side, you've got the market price, the S&P 500, opening its mouth wide to new highs. But on the other side, you have the market's breadth, the number of stocks actually participating, and that jaw is closing, falling steadily since May. That kind of divergence is a classic warning sign.
And this isn't just an S&P 500 thing. Nope, we're seeing the same pattern of weakening breadth across the board, from the tech-heavy NASDAQ to the small-cap Russell 2000. It's a big clue that investors are just piling into a tiny handful of mega-cap stocks while the rest of the market is quietly struggling.
Okay, so let's look at who's on which side of this trade. When you start to break down how different groups are positioned, you see this really fascinating split between what the professional human traders are doing and what the automated computer systems are doing. First up, let's look at the so-called smart money, the hedge funds. Since May, right around when that market breadth started to get weak, they have been aggressively selling their big tech stocks. Right now, their exposure is in the second percentile over the last 5 years. That's just a fancy way of saying they are less exposed to tech than they have been 98% of the time. They are getting out.
But then, on the complete opposite side of the boat, you've got the machines, the automated trading systems. They are massively long this market. In fact, they're at their highest level of bullish positioning in 4 years. Now, the huge risk here is that these systems often have automatic hair-trigger stop losses. So if the market turns, they could flip from being huge buyers to huge sellers in the blink of an eye and just pour fuel on the fire. And on top of all that, there are other risks hiding in plain sight. Earnings expectations are through the roof, at levels that, by the way, we saw right before the big sell-offs in 1999 and 2021. There's also this common belief that Fed rate cuts are always good news. But if the Fed is cutting rates because people are losing their jobs, that's a very different and not bullish story. And finally, almost nobody is hedged. Everyone's chasing the upside.
So, after hearing this pretty comprehensive warning from Bank of America, from the dollar chart to the weak market breadth to this weird human versus machine positioning, what are some potential actions you might think about to prepare for a possible shift?
Right, so the key takeaway from the report isn't to hit the panic button. It's really all about risk management. The 3 potential actions they outline are, first, maybe hedge your portfolio a bit by holding more cash or even US dollars. Second, think about taking some profits off the table, especially in those high-flying assets that are most sensitive to a stronger dollar. And third, just wait. Holding cash gives you the power to jump back into the market at lower prices if we do get a serious pullback.
And that really is the ultimate question this whole analysis leaves us with. Is the market truly prepared for the consensus to be wrong? Because if there's one thing history teaches us, it's that when absolutely everyone is on the same side of the boat, the biggest risk is often the one that nobody is even talking about. Thanks for joining us for this breakdown.